So Bitcoin just pulled back from new all-time highs. And this has everyone asking the question, second-guessing themselves, wondering, is this the beginning of a meltdown? Or is it the setup for the biggest breakout of the cycle? Moments like this always divide the market. Some see exhaustion, others are permabulls and see the beginning of something great. But what's happening right now runs deeper than sentiment or speculation. There are signals moving everywhere at the same time, signals that rarely will find themselves in headlines, news, and media everywhere, and for a reason, mind you. But when these signals flash together, which we're going to get into in today's video, they tend to rewrite what comes next. So across the charts, the headlines, and the balance sheets, something is taking shape that most people have not noticed yet. But if you are following the signals, which I imagine you are if you're here tuned into my channel, then you would feel the tension building like the air before a storm comes through. So in this episode, we're breaking down the hidden setup that could very well stimulate Bitcoin's next move and what it could mean for everything else that follows. So let's get into it. Let's talk about what's been really happening behind the scenes. Because while everyone's been staring at the charts, something bigger is quietly forming. We see BlackRock's Bitcoin ETF, known as IBIT, just pulled off one of the biggest inflow weeks in US history. $3.5 billion came in during a single week, making up around 10% of all ETF inflows across the country. So this means traditional investors, such as pension funds, family offices, money managers, are now allocating Bitcoin the same way they treat stocks and bonds. And this is not just a one-off spike or one-off event. BlackRock has been buying Bitcoin for 7 weeks straight, adding more than 54,400 coins to their ETF. So week after week, they've been stacking. That is no hype, no tweets, just quiet accumulation. So this kind of consistency usually points to a long-term strategy and not just a trade, especially when it's not widely publicized and you don't see a lot of hype around. It means they're moving in stealth for a reason. All while S&P Global just announced they're launching a new hybrid index that basically blends cryptocurrencies with crypto-related stocks. So think about what that means. One of the most established financial data companies on earth is about to make digital assets part of Wall Street's daily benchmark. So when we've got BNY Mellon, one of the oldest banks in America, testing blockchain-based tokenization deposits across its $2.5 trillion payments network, that's a huge deal because tokenized deposits basically let them move cash instantly, 24 hours a day, instead of waiting for bank wires or clearing times. It's faster, cheaper, and programmable. Exactly the kind of infrastructure shift that pulls the rest of finance onto crypto rails. Even Deutsche Bank analysts are now projecting that Bitcoin could eventually sit alongside gold as part of central bank reserves by 2030. So this is a complete mindset shift from a speculative trade to a monetary asset governments may one day hold on their balance sheets. So hopefully you see what's happening here. The conversation around crypto is changing. It's not about will institutions buy anymore. They already are. It's about how deep they'll go and how that reshapes everything else because there will be a ripple effect. We see this initial pump and bull run across institutional players, but this essentially, in my opinion, serves as marketing for the rest of the world and retail. So eventually there is a ripple spin-off effect that we will feel across the entire crypto market. So when the biggest players in global finance start building positions quietly, they're usually not chasing headlines, which is probably a good indicator of what we should also not do. They're preparing for something that takes years to build out, which should also be our mindset. Even with this kind of structural demand building behind the surface, behind the scenes, markets don't move in straight lines, and it's so important to remember this so you don't get wrecked and you definitely don't get emotionally wrecked, which in turn will wreck your whole portfolio. It's important to know what you're holding fundamentally, as these institutions do, hence why they're buying in such enormous amounts and consistently. There are moments when the short-term picture starts flashing signals the long-term players can afford to ignore, but traders can't. And those signals are starting to show up right now. Let's talk about leverage, liquidity, and the hidden friction lying between these. When institutions continue accumulating, as we just said, because they understand the long-term journey of Bitcoin and strategic blue chip crypto tokens. Short-term traders, on the other hand, are stretching the market. Over the past week, open interest across crypto futures jumped by 19%, adding more than $7 billion in leveraged exposure, while Bitcoin's price climbed 13% during that same period. When this kind of leverage enters the system faster than price can adjust, it usually means traders are chasing. Longs piled in late, funding rates rise, and the market gets heavier with every candle. And at the same time, short-term whale, which are wallets holding over 1,000 Bitcoin bought within the last 5 months, are sitting on roughly $10 billion in unrealized profits. Around $5.5 billion of that has already started moving onto exchanges, which often happens before some profit taking kicks in and or trading. So that's the tension we feel right now. On the one side, institutional inflows are acting like an anchor, steady, methodical, and patient, and if anything, accumulating more. However, the other factor that affects the market are traders, which are leaning hard into leverage, trying to front run what they think comes next. Those two forces can't stay in balance forever. And in the past, this kind of setup has been a reset point. We saw it in 2017 and in 2021. Moments when open interest spiked, funding went vertical, and prices cooled off before the next move. Now, it doesn't always mean a crash, but it usually means the market needs to catch his breath. Still, there's a deeper layer to this that most people overlook or simply just don't know. And that is that 61% of Bitcoin's circulating supply hasn't moved in over a year, and 17% has stayed untouched for a full decade. That's record high conviction. It shows that while traders are flipping contracts, a little ADD over there, holders with real supply are barely moving, which ultimately tells us our market is very, very steady, is not going anywhere, especially as institutions continue to buy as well. So what we have now is pressure building on both ends. New leverage entering, long-term supply staying locked. It's like two tectonic plates pressing against each other. Eventually, something has to give. Some pressure has to be relieved. And when it does, it usually clears the path for the next phase of the market. Because remember, the market is a living, breathing thing composed of all of us and all our emotions and actions. So, all right, now let us shift gears and talk about gold. Let's look at what's happening in the bigger picture, because some of the signals we're seeing right now have only shown up a handful of times in history. Gold just crossed $4,000 an ounce for the first time ever, as I was saying in my video yesterday, doubling in price in just 19 months. The last time gold moved this fast was in the 1970s, right after the US ended the gold standard and Bretton Woods system collapsed. Back then, the dollar lost its peg, inflation soared, and global confidence in fiat currencies cracked wide open. That period in time changed how the world thought about money. And now, 50 years later, the charts are starting to rhyme. The US dollar index has dropped 10% year to date, its steepest slide in 4 decades. And deficits are running above 6% of GDP. The Fed is preparing for rate cuts while inflation's sticking near 3%. Every one of these variables points to the same thing. Capital is searching for something it can trust. Gold is obviously the first stop, but this time it's not just gold. Bitcoin ETF inflows are surging. Nearly $900 million came in yesterday alone, for instance. That marked 7 straight days of net inflows, right alongside gold breaking its record. So the two assets are now moving in tandem, signaling that investors are diversifying their hedges. When gold and Bitcoin start rising together, it usually means one thing: confidence in the system is fading. Now, nobody knows how far this correlation goes or how long it lasts, but these patterns are rarely random. Markets move this way when people stop trusting the denominator, the currency everything else is priced in. Right now, we know the dollar is still the world reserve currency, but it's losing stability in one area that matters most, and that is purchasing power. And that's what the market is reacting to: the slow erosion of confidence in the money itself. So while gold and Bitcoin move together on the macro stage, there's another story unfolding inside crypto itself, a quiet rotation that's starting to reshape where capital lives on chain. Solana itself just hit a new record with more than $16 billion in stablecoin now circulating across its network. That's a signal. It means real liquidity is flowing through Solana's ecosystem. Traders, builders, and payment networks are all using it as their base layer. And over the past 3 months, Solana has captured about 40% of all new stablecoin growth in the market, while Ethereum saw around 27% during the same window of time. This kind of shift tells you where new users and projects are building. Visa, Stripe, and PayPal are already testing stablecoin payment rails on Solana, and every transaction that settles there deepens its position as one of crypto's fastest settlement layers. Now, BNB chain is also in expansion mode. It just hit another all-time high, with BNB trading above $1,300 and a market cap of over $180 billion. And YZI Labs announced a $1 billion builder fund dedicated to projects launching on BNB chain, focused primarily on DeFi, artificial intelligence, of course, real-world assets, payments, and decentralized science, which is very cool to hear. Daily transaction volume has surged past $26 million, and decentralized exchanges on BNB are processing more than $6 billion in a single day. So this kind of rotation happens when liquidity starts looking for new narratives, faster chains, bigger use cases, and better yield opportunities. It doesn't mean Bitcoin is losing strength. It means the market is expanding around it because there is a sense of confidence in where the crypto market specifically is heading. Otherwise, this money would not be moving. And Bitcoin acts as the entry point, the gravity well that pulls institutional money in. And from there, that liquidity fans out across the ecosystem, searching for outperformance. That same pattern is showing up in Ethereum as well. ETFs and corporate treasuries now hold more than 10% of the entire ETH supply. Capital is locking itself into the infrastructure layer, setting the stage for what looks like a long-term build-out cycle. And the total crypto market, excluding Bitcoin and Ethereum, what traders call the total three, has now broken above a major resistance structure that could target the $1.6 trillion in total value. That chart doesn't just represent altcoins, it represents participation, which once again only happens when traders have a general sense of where the market is moving. So when capital rotates like this, it usually means the foundation has already been laid. Builders start shipping faster, investors begin allocating deeper, and liquidity flows where utility is growing. That's what's happening right now. A quiet reordering of priorities across every layer of the space. So as we wrap up today's video, let's talk about the Great Migration, the question that opened this episode. Meltdown or breakout has a clear answer. What the charts call volatility, the data calls transition. Right now, Bitcoin is consolidating at record levels while institutions, treasuries, and builders are laying the rails of a new liquidity system. We see gold at $4,000, ETFs at record inflows and consistent inflows, Solana and BNB chains expanding, and regulators preparing frameworks, all pointing to one thing: the foundation of programmable finance is locking into place. This is the hidden setup, the quiet phase before acceleration most people miss because they're just too short-sighted. But we have to act as smart money does, that is long-sighted. So stay early, stay plugged in. Thank you for joining me here today, because I believe what looks like a pullback on the screen is the prelude to something much larger. It's just the market taking a deep breath as we look at our new targets in the horizon. So I remain bullish. I don't know what this bull market will actually end up looking like. Nobody does, but I believe the signals I just shared in today's video definitely paint a picture. So I stay ready, and I hope you do too. I love you guys so much, and I'll catch you guys in my video tomorrow. Take care.